I'm Joshua Dudgeon with Real Estate Investment Results. You can check us out at realestateinvestmentresults.com. We are going to talk about a little bit about investments. We are a real estate investment company that buys, fixes, and sells, and also builds new, and then does a general broad portfolio of different types of real estate investments. And I'm going to talk today about the value and the difference between a secured investment and an unsecured investment, and not from the typical context of the way a mortgage looks, but from the context of how safe your investment portfolio can look. Many people like the liquidity of stock market investing based on the fact that they can almost immediately, especially if you're on an app like TD Ameritrade or whatever the latest and greatest app is, you can almost immediately move your money out of the market very, very, very quickly within like seconds. And that liquidity is seen as a kind of blanket security in the fact that if the market starts to crash, you can sell quickly so you can get out properly. The problem with that context is that one of the hardest things to do, and you can watch every major investor on YouTube or even on national TV, and that is one of the hardest things to do is try to predict the market. So it's almost impossible to predict the market, and really the big players in the market, the guys that run hedge funds or the guys like Warren Buffett who are running billions and billions of dollars in the market, they actually have the ability to make the market move. And I'm not saying they can do it all by themselves, but when an event happens like the coronavirus issue that happened in the last few months, they many times, and this is a belief more than a provable fact, but they many times will move so that the market will do more moving, because they make most of their money when they get volatility. So if the market is steadily ticking upward, it is to the advantage of the long-term portfolio, retirement portfolio investor, which would be your mom and pop investors who have money in that market. But the volatility advantages the guy that's running millions, if not billions of dollars. So why is this valuable? Because they can sell a position so quickly because of they can do the exact same thing you can do, but because they're selling so much, it actually is causing other people to see, oh, the market's coming down, and it causes the panic. They are not selling. Anybody that's working in that high-end part of the stock market, they're not selling for a permanent situation. They're selling primarily to go to cash so that they can get back into the market where they think the bottom is. Now, how do we use this to our advantage? Just from understanding where the market is, if you're trying to predict the market. Number one, what just happened is the market went from like 27, I think we were close to maybe 29 at some point, and I'm talking about the Dow. I'm not going to talk about every one, and it dropped to about 18, okay? Now, if the market was in worse shape, it would keep going down, but when it hit 18, it began to come back up, and many times on the verge or on the days that bad news happened. So if you want to look at what just happened, we're in 2020, this is the Corona event just happened. The day that the largest unemployment numbers came out in really history, I believe, the stock market bumped. Now that was a signal that we had hit the bottom. So there's different things that cause signals. You can't predict the market, but you can look at signals. And then what happened was it slowly ticked up from there. And the other day we had on a Saturday, Sunday, because of this other event, there was cities on fire and rioting in multiple cities. And on Monday morning, the market jumped. Well, how could that possibly be when everybody thinks that the economy is in the tank? Well, it's because the fundamentals of the economy are good. It's because these things that are happening are not going to actually cause the economy to slip as far as the screamers are calling for. So many people think that it's going to be 2 years before we recover, and I would agree on that based on the context of the full recovery of every facet of the economy will take 2 years. But most things will be back within, I believe, 6 months or even better than that. Now, there's a bunch of companies that are going to go out of business. JCPenney just filed for bankruptcy, which is one of the last big retailers in the local shopping mall. I think it's the last anchor. And so that is going to happen. There's going to be businesses that go out of business. But in general, the economy is very strong. So those big time investors who got to a position where they likely sold at the high to get the market to move, then bought back in at about 18 because they knew that it was going to go lower, and that's why it's continued to tick up, is because the fundamentals of the economy are strong. Now, how does that differ from what happened in 2006, 2007, 2008? Well, what happened in 2006, 2007, 2008 was you have to go all the way back to 2003 when we were in the Iraq War at the beginning, and President Bush was actually selling the war on the backs of a strong economy. And that strong economy was based on how strong the housing market was. So the political will and the banking will, and really there was a bunch of major fraud and abuse happening in the banking world as well, was creating the fundamentals of the economy to be very negative, even though the world or the political and the investor world was saying, oh, it's going to go up and it's going to go up forever. By the way, if everybody starts screaming it's going to go up and go up forever, that is actually another signal that it's about to go down. So you kind of want to balance on those contexts. But when 2007 came and the market started to come down, the reason that it didn't stop coming down until it went way low was because the fundamentals of the market were upside down. Now let's take this back to liquidity. So liquidity means that you can sell quickly, but it also means that you can, your portfolio can drop quickly, which is what happens. And the hardest part for the unsophisticated, so the small mom and pop portfolio, the hardest part about investing in a liquid market is that you have to stomach the down. It means that you are gonna have to sit there and watch your portfolio dwindle. And it's like, if someone's worth $1 million in this last little crash that went from 27 or whatever it was down to 18, if you're worth $1 million, you lost $200,000 to $400,000 depending upon what you're in, like basically 2 weeks. I had several investors call us because we're in real estate, which is an illiquid asset. I had many real estate investors, or many of our investors called us saying, what should I do? I said, the first thing to do, don't sell. There's a lot of people that took advantage and said, sell and bring me your money. The reason I tell people not to sell is because they're going to lose about 20 to 30% of their portfolio, and I will not be able to make that much up for them in the short term. It would take me, I can make that up over a year, but depending upon the investment, depending on how much they come in, they're way better off waiting for this to bounce back because the fundamentals of the market are strong and it has bounced back. So that ability or inability to stomach the downturn is what the liquidity of the market causes. And so a lot of people that are short-term investors, or not short-term investors, long-term investors working in a liquidity type market like the stock market, have a very hard time listening to the radio every day and hearing that the market just went down again. And so with that, that's why investing in a illiquid asset like real estate is so valuable. Now, what have we done as a business? We have actually created an illiquid asset class, or taken an illiquid asset class and made it more liquid with how we run the business. Meaning we actually are taking all the pains out of buying a house, talking to a realtor, talking to a contractor, talking to a tenant, or dealing with any of that type of business, and allowing people who want to invest in the real estate asset class, an illiquid asset, and allowing that to allowing them to invest without all the headaches of dealing with that, because we take the headaches out by our business. Next, we not only is your money tied, your investment dollars are tied to an illiquid asset, they're tied to what's called real property. That's why it's called real estate. It's an actual physical asset, which creates another level of security. It's illiquid, but your money is tied to something that will retain value through the ups and downs. and it's tied to it with not only a note mortgage, but we have a title insurance that allows it to have clear title no matter what. We have warranty title is what we use. And then we also have a hazard insurance on the property, so if the property burns down, the investment is secure because it gets replaced or the money gets paid back. And then we also have the most secure aspect is what your money is tied to is at a 75% LTV or less of the finished value of the property. So if you're looking at, we'll go with $100,000 first. If it's a $100,000 property, your investment dollars that went against it are 75,000 or less. Many times they're as low as 50, which then really creates, so if the market does come down and everything has to get liquidated quickly, you have a buffer of a minimum of 25% before your equity gets dinged. Many times it's even lower than that. The most important thing in investing in real estate is, from the investor, the cash investor's perspective, is that their loan to value ratio is got enough room that a 10, 12, 50% drop in market will actually not affect their dollars that they invested. The best part about investing with us is we're in the Midwest, and it's really interesting because I was talking to a guy this morning, returning a computer on Amazon. He said he was in Florida and he was talking about real estate with me as he was working on this computer return. And he said, yeah, we're in Florida and things are pretty hairy. And I said, yeah, Florida, Arizona, and Las Vegas are the three bellwether areas that we look at, because what happens in Vegas, we get about a three-year run rate. And what happens in Florida, we get about a 2-year run rate. Meaning, if Florida goes to half, it takes 2 years for that to get to the Midwest. So we know that we have to sell or liquidate properties within that 2-year window. And the other benefit is, if they go to half, when they went to half in 07, 08, our market didn't dip more than 10% on average. So the dip itself is less. So that's one of the big advantages of being in our local market, which is the Midwest, and then tied to a real property, which is an illiquid asset, which through our methods, we actually make liquid, and it fights against the liquidity of being solely in the stock market with your investment. If you just went through one of these dips, you know exactly what I mean. You turn on the radio, the market dipped again today. You didn't get out when it was at, let's say it's at 27. You didn't get out at 24 because you didn't think it was going to drop more. Now it's at 21, and now you're worried about losing so much of your portfolio that you won't be able to make it back. So then you sit on, now you're at 18, and you're like, oh no, I'm not kidding you. I've heard at least 100 people say to me, oh, when I was at 18, I just didn't know what to do. And then turning on the radio even sucks, because you have to hear, oh, the market dipped again today. And people don't even want to look at their portfolio when they see that. So if you're interested in an investment that is secured by real estate, all the things I just told you, has title insurance, has hazard insurance, is tied with a note mortgage to a real investment, and most importantly, has a loan to value ratio of less than 75% of the finished value, give us a call. You can call my cell phone, 608-306-1199. That's 608-306-1199. Or you can go to our website, gives you a lot more detail, realestateinvestmentresults.com. A shortened URL is reir.co. Hope you enjoyed the video. Leave comments if you want any other discussions on more investment topics, and we'll talk to you again soon.